What's going on, everybody? Michael Silva here. Welcome to the Stock Market Brief Show. We got a lot to talk about. I've been out for about a week or so, been finalizing the move into our new house and taking care of a newborn son. Yes. Busy stuff. We got a lot of interesting charts to be going over today. We're going to talk about some signal charts that have been signaling to me that we might be matching up with seasonal rally. But there are some definite caution signs out there. We'll be discussing that and more on today's Stock Market Brief Show. So let's go ahead and get into it. Alrighty, people, welcome back. We're going to start off here. Look at the headline, right? Jerome Powell is out today with the Fed interest rate decision to hold rates where they are. And the committee is not thinking about rate cuts right now at all. Now, it's kind of funny because it kind of flashes us back to 2020, in the middle of 2020, where they said, we're not thinking about raising rates. We're not even thinking about raising rates. And I showed this over here to show you what it looked like, where they said they weren't even thinking about raising rates right over here. Shortly thereafter, well, they jacked them up to the sky, and now they're over here, right? And we're not even thinking about cutting rates. So I wonder if it's going to have a very similar type effect where in a very short period of time, they're going to be slamming them down or something crazy, would have to take place for them to reverse course. Now, if we take a look at the Fed Watch tool, over here, you can see that they are holding rates steady. If you look at Fed funds futures, that is, till about May 1st. So that's the middle of next year. And then June looks like the probabilities of a rate cut increase. So we'll see here. The Fed was pretty hawkish overall. So begs the question, is this bounce that we're currently seeing just a fake out? Is it just another lower high being formed? Well, we'll get into that momentarily. If you take a look at the S&P 500 monthly expected move, we tagged down in there. That's that thin gray line right there. We got over there, and then we're starting to bounce from that level. I'll update you on the new monthly expected moves for the SPX today. Now, the S&P 500 weekly time frame. We had discussed that when we get extended from the weekly 5 EMA that you can see quick snapbacks. And it goes for both bearish cases and bullish cases, right? If you get way extended right here, right, like we did, we snap back. When you get under, like, cut way beneath the 5-period weekly EMA, you can snap back. You get above it, you snap back, and so forth, back and forth. And we got way extended, and we snapped right back to it. Now, where can I see potential resistance? I'd say this golden zone up here at the 50% to 61.8% retracement level, measuring from this swing high to this swing high. And you can see in 1 week's time, we erased all of last week's craziness, coming where? Right back to that flat to declining weekly 5 EMA. So we're not too far off of this little golden zone up here. I think the last time we discussed this weekly chart, we said I'd see some potential resistance up in this area, which is we'll call it 4280 to round down a little bit, but that was right around this close, this opening price, and this low over here. And then when we broke down, we saw a pretty nasty move to the downside. So perhaps we still have a little bit more upside. Now, as far as the new expected moves go for the S&P 500, they're the solid thin line. So you have 43.66 to the upside for this month, and you have 40.21 to the downside for this month. Remember, these are just thinking about in terms of probabilities. They're a distribution curve. 68% of the time, it closes within these expected moves, and even on the shorter time frames, it happens as well. But it doesn't mean, you can think of it as a coin toss, right? If you flip a coin, right, it has a 50% probability of landing heads or tails, and there's going to be times where it lands on heads multiple times, and you're going to be like, no, it's actually heads will land more. No, well, if you do it over the course of time, longer and longer, it should even itself out to be that 50-50 ratio. Well, the same thing goes with these expected moves. Sometimes you'll get outside of them, but a lot of the time, 68% of the time, over the course of time, it will close within it. And when you look at something like the SPX, which is even a larger product, that 68% is actually higher. It's typically more north of around 80%. It closes within those expected moves. If we take a look at the Qs, we tag down to that lower monthly expected move as well, and we're bouncing right back up to and around that monthly 5 EMA. The Q, or the IWM, is the one that tagged. This is where I said where there might be potential to either one just completely snap and break, or potential for a bounce where it came down to its quarterly move, and we closed outside of that monthly expected move there. Now, I'm not going to update you on the Q monthly. and the IWM new monthly expected moves, just the SPX at this current time. Now, we still have a lot of stuff on deck for earnings. We have Apple. This is going to be the largest market cap name. So these are all names from the S&P 100 that will be reporting tomorrow. And then after the bell. So after the bell is Apple. And right now it's at about a $6.50 expected move. So come into tomorrow, it'll probably could be roughly around there. Might get a little bit bigger as implied volatility swells up like a puffer fish, but we'll see here. And then just understand that that's a large move. And if it's a negative move, I mean, it could have a drastic effect on the overall market because it's one of the larger market cap names in the S&P 500. It is the largest. If we take a look at the 11 sectors that make up the S&P 500, tech ruled today at 1.93%. So seeing a nice little bounce there. You have XLC and XLY. So pretty risk on type of day. However, utilities is still holding strong over here, up 1.14%. And that is actually outpacing the S&P 500. So it's actually outperforming the S&P 500, which is thrown up a couple of mixed signals, in my opinion. Overall, the index products did quite well. We do have some important macro data still remaining on deck. We have tomorrow initial jobless claims. We have factory orders at 7. So this is important to know because this is during the trading day, right? I'm looking at Pacific Standard Time. So this is 10 a.m. Eastern Standard Time. And this right here is an hour before the market opens up. So if you look, if you're trading the market when it opens, just make sure to just know that 30 minutes into the open, we're gonna get a macro drop, and you could, if you're in a trade and you think things are fine, and all of a sudden you get this huge whipsaw type of move, that could be factory orders, right? It might have an effect, it might not, but when these typically hit the tape, you can see volatility pick up. If we take a look at Friday, we have some more major type reports, which is non-farm payroll, unemployment, and ISM services PMI, to just name a few. Those ones highlighted in red are the more major reports according to Trading Economics. If we take a look at the dollar's still holding strong over here in a period of consolidation. And you can see the S&P 500 rose today alongside the dollar, which typically there's a negative correlation, but you have days where they kind of sync up too as well. But if the dollar is going to continue to rip higher, just know that, hey, over the course of, 30-day correlation, 90-day correlation, there's typically a negative correlation. So if the dollar keeps on continuing to go higher, it could very well put more pressure on the S&P 500 and other assets. Gold has been holding up rather well, even including today, despite a rising dollar. And obviously with a rising dollar, gold has been doing pretty well, which is very interesting dynamic in the overall markets because there's typically a stronger negative correlation. So gold still remains quite elevated, which feels a little risk off in my opinion. Could be because of the geopolitical risks that are taking place currently overseas. Look at the 10-year yield. The 10-year yield backed off a little bit. We had mentioned that this negative divergence in the RSI and the price momentum oscillator might say that, hey, we can start pulling back a little bit. But I want you to just know that this is still an up channel. It's still an uptrend. So even pulling back to around that 4.6, it's a higher low in the midst of other higher lows and higher highs, and that is a uptrend overall. Okay, so just because we pull back a little bit, maybe we see a little bit of relief, but do not think that this thing can't continue to press higher. It could very well just be digesting what Powell said. And then also we have that jobs report, which is obviously has a big impact on yields respond to those major reports. If you take a look at the TLT, overall, we are still in a downtrend, but we had price start to contract up, right? We saw this tight little falling wedge over here. I don't know if I labeled that here, if I talked about that in my Discord group, but we bounced up and we did tag that little target of the 20-day declining moving average. And I just want to call out, we did close above it, so maybe perhaps there's a little bit more juice if the 10-year yield wants to take off a little bit, but we're still overall in a downtrend here. We're playing from that positive divergence in the RSI and a positive divergence in the price percent oscillator. If you don't know what a positive divergence is, it's basically just in quick, it's showing us that price is weakening, okay? However, the internals are putting in a higher low, which is showing us, hey, well, the indicators that we're tracking are showing strength while price is coming down, which could give us insight to a potential bounce in price. And that's kind of what we're seeing play out as it stands. This bear flag did play out on crude oil. Is it something to worry about, or is this just pulling back a little bit here to flattening to rising now 200-day moving average? So that's kind of my target area of where I was watching. You can see we have a flagpole, we rose. A flagpole would probably measure down to around that 200-day moving average. We had that negative divergence in the price percent oscillator over here. Some might look at this now and be like, well, we potentially have a head and shoulders pattern where if you measure the head, we break the neckline, it could take us back down to around 67.50. That's always a possibility, but we've had a few days now to the downside, not too far off the 200-day, so I'd be thinking that we can see a bounce in the near future here in the price of oil, especially if the 10-year yield, comes down a little bit and then starts rising again. It's likely to see oil follow suit, which we've talked about in prior videos. Take a look at copper. Copper was flat on the day while the S&P 500 had a nice big up day. So a little bit concerning there as we're getting some topping tails in the price of copper, and we're just seeing a bunch of series of lower highs. And obviously we're seeing lower highs there in the S&P 500 as well, where there is typically a strong correlation between these two assets as well. So if this starts breaking back down, I'd expect this rally over here to fail. Now we do have some signal charts that are showing that could line up with potential seasonality to finish strong throughout the year. So I'll go over those just so we know when they could potentially move into more of an overbought condition. But as it stands, we have that low there on the bullish percent index for the NASDAQ composite, but you can see the RSI is also in an oversold state, but it's also a higher low there. So you have a low, a lower low, a low, and a higher low, which can very well play out to be a potential move back up to the upside where we get some breadth in the market and we follow through with a bounce in the NASDAQ composite. The BP NDX as well, series of higher lows, series of higher lows, series of lower lows there in the bullish percent index for the NASDAQ 100 as well. For the technology sector, no surprise here how you have a low, a higher low, a low, and a lower low there too as well. Bullish divergence, right? So it's playing currently, it's playing to the upside, and you can see we're no longer in that oversold state. The bullish percent index for the SPX, you have a low, a lower low, you have a low, and a higher low over here too as well. And it's in a pretty beaten up area. So breadth got pretty bad here, and we're starting to bounce kind of from this area. So you'd want to see this really cross back above 30 seems to be the key level where you get back above 30. You see these rallies follow through, back above 30. See the rally follow through, back above 30 right here. We've had a little bit of a rally. We're still kind of under there. It's very similar to how when we, got way up here and then we saw a cross back down through 70, how it can get bearish, how we saw, breadth move to the downside there, boom, to the downside right there, right here, to the downside, and so forth. So a little ways to go right there, but we do have that bullish divergence that's potentially playing out. Same thing goes with the NYSE bullish percent index. You have a low, a lower low, you have a low and a higher low right here, and even with price matching that too as well. So is there going to be a potential bounce here? SPX, the percent of stocks above the 50-day and 200-day, I did find this to be interesting where it had a low, a lower low, but yet the percent of stocks above the S&P 500 put in a higher low, which is showing a positive divergence. And this was happening in actually more of an oversold state of where we were down now around 10%, which means 10% of the stocks in the S&P 500 were above the 50-day moving average, which 10%, right, is not a lot of stocks. And when that typically happens, you can have relief rallies, right? We're still putting in series of lower highs as it stands and lower lows as it stands. So the trend remains down. But remember, even on downtrends, you get bounces. And these bounces in especially bearish markets or bearish environments, they can be absolutely excruciating to the upside, like rip your face off type of moves. If you take a look at the NASDAQ summation index, we're starting to fish hook back up, still in a bearish kind of setting right here as we're way below zero at a very low reading, but it is starting to fish hook up and the parabolic SAR is still up there. So if we start down ticking, it could identify a potential change in trend. You have that bullish divergence there that is starting to play out there as well on the NASDAQ McClellan oscillator. We talked about the bullish divergences in the NYMOT, which is the NYSE McClellan oscillator. And we're starting to see that little bounce here. We're also getting a fish hook right there as well on that summation index. I call it a fish hook from the term from Tom McClellan. He labeled it a fish hook where you can see, it start to curl around there. If we continue on, I wanted to read out the NASDAQ Cohen high-low. When we typically get a close down at this 0.05 reading, it marks areas where we can get bounces. And we're down there right now. We didn't actually have a weekly close down there, but if we close down there, perhaps that means that we could very well see a bounce in the near future. You can see I've marked out different times where we get little bounces, Sometimes they could get faded, you get little bounces, but it's marked off sometimes bottoms. And you could pair this with something like the NASDAQ record high percent index, where we're getting a massively low reading over here on the 10 period EMA. And when you get a breadth thrust back above 35, it's marked out bottoms in the, the dot-com bust, the great financial crisis, over here going into 2012, over here in 2016, which also happens to be, I think, a period where we had 3 months down in a row. Over here and during the pandemic, which is also one of the other areas. No, sorry, that wasn't the, where's this pandemic, or was this over here? I can't even remember now. No, that was the Christmas Eve massacre. Over here was the pandemic. I'm getting them too confused. So we saw that right here, this breadth thrust. It actually didn't reach down there in the pandemic, but that's where we had those 3 months down in a row. Okay, and then over here was the October low. We got that breadth thrust. So waiting for something like that for confirmation could be beneficiary. If we continue on and look at the NASDAQ composite, this is the old fool indicator. It's basically taking the NASDAQ composite, dividing it into the total put to call ratio, and applying two EMAs, the 21 and 50. When the green line goes above the blue, it marks a buy signal. When the green crosses below the blue, it marks a sell signal. Last time we had a buy signal was right around this area where we got a nice rally. Last time we had a sell signal was right over here. It's a lagging indicator, but it could identify longer term trends. You can see we just went down, we went up, we went down, we went up, we went down, and we went up. And where are we? In a downtrend. It identified the downtrend, and we haven't crossed back above yet. So to see this get confirmation too might be a good thing to have in your arsenal. Now, if you take a look at seasonality of October, right? I'm showing you what October was. We're not in October anymore, but this is from Almanac Trader, and he did point out that, hey, it was matching all the way to the end of October, where you typically get lows on a pre-election year, right? You're taking a look at the Russell 2000, you typically get weakness, and then you get a little move higher towards the end, which is what we're seeing. If you take a look, though, and you measure it out, how the purple line is 2023, right, into October. And then right here, he's just pointing out that typically you get rallies, even pre-election years. If you take a look at the green line, or even the first term pre-elections, where the purple line is the blue, and then the aggregate cycle is the red line. But you can see typically all across the board, you get rallies into year end. If I look more specifically into November, you get a nice little rally at the beginning, then it kind of fades off, and then it really starts to pick up towards the end of the year. Not quite as much for pre-election years, which we're currently in. However, the ones that do perform better towards the end of the month and for pre-election year was the Russell 2000 and the NASDAQ composite, to name those two. You can see those red and blue lines. So are we going to just get it continue kind of like little bit bump up, then kind of fade off a little bit, but then towards the end, are we going to rally up and see a potential move higher? Well, the signals that I just recently pointed out, they are showing bullish divergence, which say that we could very well follow through to the upside. There's obviously a lot of risks that we pointed out there too as well. I wanted to call out now the daily chart of the S&P 500, and then we'll get even more tactical within the daily expected range for the smaller chart of the SPY. So if I'm looking at the SPY here on the daily time frame, take a look here how we had this left shoulder, head, right shoulder. I think we made a video about this a while ago, and we said it's never this easy, right? We talked about it right here. It's never this easy. We could rally up and so forth. Well, if you measure the top of the head to the neckline and you measure the neckline break down, take a look at just how, perfect that measured move was right down into it. And then we started to bounce from that level. Now, we broke the year-to-date anchored VWAP, and we said, be careful here because sentiment could change and more sellers could step in. Boom, we saw that flush, and now we're starting to kind of get this little rally back upwards, back up to where? The 200-day moving average. Now, the reason why I'm not too worried about the 200-day is because it's not declining currently. It's still inclining at this time. It's going to take time to move this to flatten out, then to potentially turn over, and that would spell out more drama, obviously, for the S&P 500. Paul Tudor Jones has a famous quote saying, nothing good ever happens below the 200-day moving average. Well, we're still below it. However, we're trying to recoup it so it doesn't flatten out to turn back down. If we take a look at the quarter-day anchored VWAP, we broke through that. Look how sentiment shifted, boom, to the downside, and we're still below that declining one. So we're seeing a very strong rally off the bottom here. But as we stated previously, what do all these highs have in common? They're all lower as it stands. So the S&P 500, to get up here, first, it's not going to be a straight shot typically, right? It typically has to breathe, show some volatility, scare some people out, and then shake itself back up. That, and then people will start looking at this. If that was the case, they'll be like, oh, now it's an inverse head and shoulders. So you had head and shoulders, now you have the inverse head and shoulders. Here's the neckline. We start breaking above, and we can start trying to take out over here for the year end, which would be more of the bullish, obviously, case. Now, if we can't recoup these levels, right, if we rally up or we come right back down, the main area that you'd obviously want to hold would be this low, right? Because this low, even if we come back down here and we start moving back up, this would be a low, this would be a higher low, and if we could take out whatever the high is, wherever this price goes, if we could take it out, then we would have our first higher high, right? And then we have to go for this big guy over here. So that's kind of what I'm looking at from the daily perspective. If we take a look now and get a little bit more tactical in the 15-minute time frame, first and foremost, we kind of just smoke through the weekly expected move, and we have obviously more macro data to come, and we have Apple earnings. So if the market perceives it as bad, boom, we suck right back into the weekly expected move, no problem. If we start sucking back in within the weekly expected move, start looking at the October low anchored VWAP, which is right by about the week to date anchored VWAP. So we're right there. If we get a subtle move to the downside, we want to hold those levels. On a positive note, we are above the 5-day moving average. So we talked about how price was contracting, and contraction leads to expansion. Well, price bounced up, and what did it do? It started contracting again. Now it's expanding. We broke out, okay? One thing to also pay attention to is we had this inverse head and shoulders pattern right over here. We tightened up on the right side. We broke out, and this is about a measured move. A measured move would take us, which is, just a technical way of measuring something. It doesn't have to reach there, just to give you an idea of a potential target. It happened to play out pretty well here. But if you watch it here, that would be about the technical move right back around of the daily expected move going into tomorrow, which is 426 rounding up, and then that quarter to date anchored VWAP, which could act as a potential level of resistance. Remember, 68% of the time we closed within these weekly expected moves, daily expected moves, and so forth. But remember, as you get outside of them and you start breaking away from them, right? If you think about how much money, right, creates, in these option markets, creates these weekly expected moves. In the SPX, for example, it could be billions of dollars traded within, to give us this idea of risk. And when you have billions of dollars incorrect, well, what do you think is going to happen? Well, once you get further and further into incorrect territory, buying begets more buying, and so forth, and it can really push price out of those levels. So are we going to see that? Well, what you can do is you can go into smaller time frame charts, look at the minute candles, and if all of a sudden you get large boom, boom, boom spikes of volume, that right there would probably be dynamic hedging taking place, pushing price further and further outside of those weekly expected moves. I'd be paying attention tomorrow to 426 to the low end, 419.33 to the low end over there. If we start breaking even further, obviously the low anchored VWAP. I will call out, we do have that negative divergence on the RSI. We have a high, higher high, a low, lower high right here. So if we do get up a little bit further starting the day out, I'd be very careful within this area, as we might get an early morning fade. If the fade kind of consolidates or sucks back down, maybe perhaps as price tightens up, we can see a bounce back, but just be aware that, beware of what's known as a gap in trap, right? Where you gap up, people are like, oh, it's time to go. And then all of a sudden it sucks in a couple of people and then pulls us right back down into these lower areas. Okay. That's what I'm looking for going into tomorrow. Hope that helps everybody. Glad to be back. See you later.